Dear students, in our previous classes, we have learned about the different methods of quantitative credit control and qualitative credit control. We learned only the methods of credit control. Today's class, let us discuss what are the major differences between quantitative and qualitative methods. There are some major differences between quantitative and qualitative credit control policy of the central bank. They are as follows. First, let us take up quantitative credit control. This credit control measure aims at regulating the total volume of credit in an economy. In this first point, you need to focus on total volume and link this point total volume with quantitative. Recollect when we discussed about quantitative credit control methods, we learnt about bank rate, OMO, CRR as well as SLR. When I discussed those, I clearly mentioned depending upon the situation, whether is it inflation or deflation, the central bank regulates the total volume of credit. That is, either it controls or expands the credit. That's what this type of measure regulates the amount of credit available in the economy. Whereas other side, qualitative or selective credit control, this measure aims at controlling the flow of credit in some selected areas. When I say flow of credit, to which sector the credit supply should be allowed. So the major difference in these two, you observe, to the left hand side volume of credit, to the right hand side it is flow of credit. Come to point 2, it regulates the availability of loanable funds with commercial banks. For example, if bank rate is increased, volume of credit available clear decreases. Of course, loanable funds also decreases. Suppose if bank rate is decreased, vice versa. Same way, when loanable funds of the commercial banks get affected, the control, it controls the investment in all the sectors of an economy. This is what we have learned under BRP, SLR in our previous classes. As this quantitative technique affects the loanable funds of the commercial banks, investment, employment, income gets affected. Come to the right hand side, it regulates the flow of credit from commercial banks on the basis of the purpose of investment or credit worthiness of the borrower. So in this second point of difference, focus on the availability of loanable funds, whereas the other side flow of credit. So two major points focus. Go to the third point. In point 3, quantitative credit control measure uses instruments like bank rate policy, open market operations, cash reserve ratio, statutory liquidity ratio. Remember, both these CRR and SLR put together, we call it as VRR, that is varying reserve ratio. In fact, under the VRR, these two have been further classified. Come to right hand side. Qualitative credit control measure uses instruments like margin money, differential rates of interest, moral suasion, etc. Now, you should not be in confusion as far as these terms are concerned. Margin money, differential rates, moral suasion, or the other side, bank rate, open market operations, and all these, because detailedly we have learned the differences, clear, and the meanings. Come to point 4. This measure affects equally backward and advanced sectors of an economy. That means here there is no any preferential treatment in quantitative. Irrespective whether it is backward or advanced, all the sectors get affected by the quantitative credit control measures. Come to the right hand side. This measure encourages the flow of credit in some priority sectors and does not affect backward rural economy of the country. See, when I discussed qualitative, I clearly mentioned qualitative is also called selective credit control measure. So, as it is selective credit, it selects a priority sector and it will never affect the backward rural economy of the country. Come to point number 5. Quantitative measure is more suitable for a developed economy or advanced economies. It is more suitable because they need not give priority. But the other side, you see, qualitative or selective measure is more appropriate or suitable to LDC, that is less developed country or less developed economy, because they have to prioritize the sectors. Point 6. Quantitative measures influence the total credit without distinguishing between essential and non-essential uses of credit. In the sense that as this quantitative measure never prioritize or never distinguishes between essential and non-essential things, it will just influence the total credit. Whereas the other side, qualitative or selective measures are discriminatory in nature. Go back to qualitative. We discussed about DRI, differential rates of interest. There I have told you how the rates of interest will be discriminatory in nature, in the sense that it distinguishes between essential and non-essential uses of credit. So the major difference in the 6th point is that in the left hand side you're writing it will not distinguish between essential and non-essential uses of credit, whereas in the right hand side it distinguishes between essential and non-essential uses of credit. Then these measures affect lenders. So quantitative measures affect only the lenders. How? When we discuss the quantitative methods, I clearly mentioned BRP, OMO, CRR, SLR, it affects the loanable funds. Therefore, it affects the banks, that is lenders. But the other side, it affects both lenders and borrowers, in the sense that banks and the borrowers both get affected by qualitative. Come back to the last point. These are indirect and impersonal, whereas the other side, these are direct. So in the last point, indirect, direct. So focus on these 8 points thoroughly. Clear? And this particular question is often asked in the board examination in part B or in the second part. Clear? Focus much and learn on all these points thoroughly. Minimum 5 points you should know under this section. Thank you.